Okay, let's jump light into a really important and frankly often misunderstood issue for military families. We're talking about how a simple state tax withholding error can quietly set up a hidden audit trap. And this isn't about a small clerical mistake. It's a systemic issue that can put your federal tax return right in the IRS's line of sight. And this quote you see here, it absolutely hits the nail on the head. This isn't just some minor payroll hiccup. No, this is a much bigger deal rooted in federal laws being applied incorrectly, and it creates some very real, very specific risks for you down the line. All right, here's how we're going to break this all down. We're going to walk through this whole maze in 5 parts. We'll start with the root of the confusion, and we're going to work our way all the way to the end, where I'll lay out the exact playbook you need to protect yourself. So first things first, we have to tackle the one concept that trips almost everyone up. For military personnel, where your boots are on the ground isn't necessarily your home for tax purposes. And that difference, well, when it comes to taxes, it's everything. Okay, so here's the absolute key takeaway. Your domicile, that's your state of legal residence, is your one and only tax home for your military pay. It's where you've legally planted your flag, with things like your voter registration and the big one, that DD Form 2058. Just because the military sends you to a new duty station, that doesn't automatically change a thing about your tax home. Now, this whole domicile thing is so important that there are actually powerful federal laws that act like a giant shield to protect you. They stop the state where you're temporarily stationed from taxing you incorrectly. Let's dig into how that shield actually works. All right, meet your first line of defense, the SCRA, or Servicemembers Civil Relief Act. The law itself is 50 U.S.C/4001, and what it basically says is this: the state you're stationed in can't touch your military pay, period. It's only taxable by your home state, your domicile. It even shut down this sneaky trick some states used, the California method, where they'd use your tax-free military pay to push your other income into a higher bracket. And this is huge. That protection doesn't just stop with the service member. Thanks to the MSRRA, or Military Spouses Residency Relief Act, military spouses get this shield too. It's a game changer. But, and this is a big but, it only works if you're living in that state for one reason and one reason only: to be with your spouse who is there on military orders. That's a key detail. So you've got these powerful legal shields, right? But what happens when a state messes up and withholds income tax from you or your spouse anyway? Well, this is exactly where the trap is set. Suddenly, you're faced with a really high-stakes decision on your federal tax return. So here's the million-dollar question you're now facing. A state wrongly took money out of your paycheck. Can you just turn around and deduct that amount on your Schedule A? Now, your first instinct is probably, yeah, of course, it's a tax that I paid, but it's not that simple. There's this thing called the Good Faith Doctrine, which comes from Revenue Ruling 82-208, and it basically says you can't deduct a payment you knew was a mistake and that you're planning on getting refunded anyway. So let's just walk through the chain reaction here, step by step. First, the mistake happens. The state withholds tax they shouldn't have. Then you do the right thing. You file a non-resident state return, like a California 540NR, to get your money back. The state sends you the refund. But here's the catch. They also send a little form, a 1099-G, straight to the IRS, telling them all about that refund. And just like that, a digital paper trail is created. And this is where it gets even stickier. It's something called the tax benefit rule, and you can find it in the Internal Revenue Code, Section 111. It says that if you did go ahead and deduct those state taxes on your Schedule A, you have to report that refund you got as taxable income on next year's federal return. And if you don't, ding-a-ding-ding, you've just created a mismatch, a glaring red flag that the IRS computers are literally built to find. Which leads us to the opponent in this game, and it's not a person. It's the IRS's super smart, highly sophisticated automated system. And let me tell you, this system never sleeps, it never takes a coffee break, and its one and only job is to find these kinds of mismatches. It actually has a name, the Automated Underreporter Program, or AUR for short. You can look it up in the IRS's own rulebook, the Internal Revenue Manual. Its whole purpose in life is to play a matching game. It takes all the info sent in by third parties, like that Form 1099-G from the state, and compares it, line by line, with what you put on your Form 1040. So you can see what happens next, right? The AUR system sees the 1099-G that says, hey, we gave this person a refund. Then it looks at your tax return and sees nothing, no mention of that refund as income. Beep, an alarm goes off. Your account gets flagged. This isn't a roll of the dice. It's an automatic tripwire that sends your files straight to a tax examiner's desk, all according to their playbook, IRM 4.192. And the result of that flag? It's usually a letter in the mail called a CP2000 notice. Now hold on, it's not a full-blown audit, not yet. Think of it as a, hey, we think you owe us more money letter. It's a bill, basically. It'll have the extra tax they think you owe, plus interest, and here's the kicker, probably a 20% penalty for being inaccurate, thanks to Section 6662 of the tax code. Okay, so that's the trap. It sounds pretty scary, I know, but the good news is you can absolutely avoid it. So how do you get through this maze and keep yourself safe? It's not about crossing your fingers and hoping for the best. It's about having a smart, strategic playbook. So let's go through it right now. Strategy number 1, and this is the big one. Get ahead of the problem. Seriously, the best fix is to make sure the problem never, ever starts. You have to be aggressive about this. Go to your employer, go to military finance, and file the right state-specific exemption forms before anything can go wrong. For instance, in California, that's a Form DE-4. In New Jersey, it's a DD-2058-1. You have to stop the bleeding before it even starts. All right, strategy number 2. What if it's too late and they've already withheld the money? Now you have to play chess, not checkers. You have to pull out a calculator and do the math. Is taking that federal deduction on Schedule A really worth it when you know for a fact you'll have to pay tax on the refund next year? You have to weigh the benefit now against the costs later. And that's all assuming you could even argue it was a good faith payment to begin with. Number 3, get your paperwork in order. Your domicile claim is like a legal case, and you need to have your evidence ready to go. And it has to be airtight. We're talking about the Servicemembers DD Form 2058, the spouse's driver's license, your voter registration cards. Everything needs to point to the exact same state. If there's even one piece of paper that tells a different story, your whole argument, your whole protection could fall apart. And last but not least, strategy number 4, precision is everything. When you're filing to get that money back, you have to use the exact right form for that state, like the 540NR in California or the NJ1040NR in New Jersey. And don't just fill it out. On that form, you need to clearly and explicitly state that you're getting this refund because of federal law, 50 U.S.C. Section 4000. That part is absolutely non-negotiable. It's how you recover your money cleanly without raising any red flags. So when you boil it all down, what have we learned? For military families, tax compliance is so much more than just plugging numbers into a form. It's about actively standing up for your legal protections against automated systems that can and do get it wrong. That domicile we've been talking about this whole time, it is your single most powerful tax shield. So I'll leave you with this question. Is yours properly documented and ready to be defended?